Solo 401ks are the best retirement account for self-employed business owners that have no other employees. Whether this is your main hustle or your side hustle, you should be using a solo 401k. Now, in today's video, I'm going to go over the contribution rules, how you can get in $69,000 a year for tax year 2024, what the deadlines are on when to get it in, and the process on how this works, because it's different for S-Corps or sole proprietorships, and sometimes the rules get confusing, but I'm going to break it down and make sure you know everything you need to know to maximize your solo 401k contributions. I'm Matt Sorensen. Let's build wealth. All right, now the solo 401k is something specific for people that are self-employed with no other employees. It's basically the way the government has said, hey, you self-employed people, you can have your own 401k, or you can put money in as the employee, and you also put money in to your own 401k as the employer because you are self-employed. So a lot of people are familiar with 401ks where you have an employee contribution and the company you work for does a match. In the solo 401k, it's the same thing. It's both coming from you because you own the business, but you do need to calculate this as an employee contribution and an employer contribution, and that's how we get up to $69,000 a year into your solo 401k every year. All right, now let's go over employee first. This is where you can put $23,000 a year into your own 401k, which can be Roth or traditional. I'm going to come back to that here in a second. You can put $23,000 a year into it. If you're 50 plus, you're going to do an extra $7,500, which totals $30,500 that you can put in as an employee. Now let's focus on the 23 here for a second. Now here's the rule on that. As long as you make $23,000, you can put in $23,000 into your solo 401k. Now this is an awesome rule, and this is one of the reasons why we like solo 401ks over a SEP IRA. That's another option you can do for a self-employed person. In a SEP IRA, I can just put in 25% of whatever I make, whatever my W-2 is, if let's say I'm an S-Corp. Well, if my W-2 is $50,000, I can only put in 25% of that, which is $12,500. Well, let's take the example here and say your W-2 is $50,000. Well, if my W-2 is $50,000 as an employee, I can put in $23,000 because I made $23,000. Plus, I get to do the 25% of $50,000, which is the employer, which I'm going to come to here later in a second. But the main thing I want to point out here is if I've made $10,000, I can put in $10,000. But the main thing I want to emphasize here for the employee contribution is it is determined by your W-2 for you S-Corp owners. That's the most popular for any of you solopreneurs, small business owners. If you're a sole proprietor, it's based on your net income, your net self-employment income. But most of you should be an S corporation if you're doing this strategy. So we're going to be focusing on what is your W-2. Now, I know a lot of you that do the S Corp strategy, you want your W-2 to be as low as possible. So let's say you made $150K during the year. You might say, well, I'm going to take a W-2 for $50,000. I still got another $100,000 of profit that's going to come through my K1, but that isn't used to calculate your solo 401k contribution. So if I want to put more money in, I've got to have a larger W-2. But remember, you're doing that at the expense of increasing your W-2, which you do pay Medicare and Social Security tax on, versus the profit distributions from your S-Corp, the net income, which is exempt from self-employment tax. So just know there's a cost if you're bumping up your W-2. But remember, you got to take a reasonable W-2 anyways. Okay, so in this example, again, $50,000 salary, you can put in $23,000 as the employee contribution. Now, since you own the business, you're also the employer, so you also put in the employer contribution, sometimes called the match. Now, that is determined based on 25% of your W-2. So if my W-2 was $50,000, 25% of that is going to be $12,500. So in total there, off of a $50,000 W-2, I put in $23,000 as the employee. I put in $12,500 as the employer. So I've got $35,500 in solo 401k contributions I can do off of a $50,000 W-2. Now let's do another example so you can understand how this works. Let's say my W-2 is $100,000 for my business, and let's say I'm 52 years old. Well, how much can I put in as an employee? Well, I can do $23,000 plus $7,500 since I'm over 50. So I can do $30,500. I at least made that on the W-2. Plus, I also get to do 25% of that W-2 as the match or employer contribution, which is $25,000. It's 25% of $100,000. That's why I did it, to make it easy. Now we've put in $55,500 into the solo 401k off of a $100,000 W-2. Now, if your spouse is working in the business and taking a W-2, they can also be contributing $55,500, assuming they're over 50 and also taking the same $100,000 W-2. That's over $100,000 a year you could be contributing into a solo 401k every year. This is one of the reasons I love the solo 401k. A lot of our self-employed business owners use the solo 401k to get more money in, because you can be doing, again, $69,000 a year into the solo 401k. You can do $7,000 a year into an IRA. I can get almost 10 times the amount of money into a solo 401k as new contributions than I can an IRA. It's a lot more bang for my buck, and it gives me a lot more tax benefits and deductions if I'm going traditional. Now, let's say you decided to do traditional contributions. Let's just calculate the benefit to doing that here at year end. Let's say again here you had the $100,000 W-2. Maybe you made a few hundred grand that year in the business and you decided to take $100,000 as salary. Let's say you're 44 years old and you're going to take $23,000. Let's say you want to go traditional again here, plus $25,000, 25%. That's the match. So I've got $48,000 here that I've put into my traditional 401k. Now, because I went traditional, I get a tax deduction of $48,000. Assuming you're at a 40% effective tax rate between Fed and state, maybe you're in California, 30% federal, 10% state, that $48,000 contribution is going to save you $19,200 in taxes. So it's a great tax benefit, and one of the strategies we like to look at as year end is doing traditional contribution to get tax deductions now. Now, of course, the downside to traditional is it's growing and I'm not paying taxes, I'm investing it and growing it. But when it comes out of retirement at 59 and a half or later, when I start taking withdrawals on this, I do put it into my income when I take the distributions in retirement. Now, a lot of people say, yeah, but my income will be less in retirement, so I'll be in a lower tax bracket. I'm not as worried about that. There's different schools of thought about it. I happen to love Roth. Here's how you would do this if this was Roth dollars. Let's take the same example. Let's say you had a $100,000 W-2 out of your S corporation, $23,000, say you're 44, employee, $25,000 employer. I've got $48K in total. What is my tax deduction now? Zero. I get no tax deduction. I got the tax deduction up here on the traditional, but no tax deduction down here on the Roth. Now, why would I do Roth? Well, one of the reasons you do Roth is there's no tax on the way out. It's tax free. As I'm investing the money, there's no taxes. I'm investing and growing it, and there's no taxes on the way out. A lot of people like to think, Matt, I'd rather pay the tax on the seed, this little amount of money I put in the account, versus the harvest, all the investment growth and gains I'm going to have that I'll pull out later in retirement. So tax me now, and that way I have no tax on the harvest as the money's coming out later in retirement. That's more my school of thought, but this sucks because I don't get a tax deduction now. Now, one of the new things that came out in 2023 from Secure 2.0 is the employer contribution here. In this example, $25,000 can be Roth dollars. It does not have to be traditional dollars. The old rule for 401ks, solo Ks in particular, was the match or the employer contribution must be traditional dollars. The new rule is the match can be Roth dollars. So 100% of my contributions, the employee and the employer, could all be Roth dollars. All right, now I want to go over the deadlines on making your solo 401k contributions. Now, it's different if you're an S corporation versus a sole proprietor. For S corporations, your deadline to contribute is your tax return deadline. It is not December 31st. You actually have up until the tax return deadline, which for S corporations is March 15th, plus extensions, which takes you out to September 15th. That's the deadline to get the money in for your solo 401k contributions if you're an S corp. There's a huge caveat here for S corporations on the employee contribution, because you must elect to make the contribution and it must be on your W-2, which is due January 31st, even though I don't have to put it in until the tax return deadline plus extensions, which gets me out till September 15th of 2025. And again, that's assuming you extended your tax return. Now, the rules on sole props are a little bit different here, not only on what you can contribute, but the deadline as well. The one caveat on a sole prop is it's based on my net self-employment income. This is when I go to Schedule C and I calculate what's my net self-employment income. That's like my W-2 when I'm taking the wage into account for how much I can contribute as an S corp. But on a sole proprietorship, it's the same thing. As long as my net self-employment income is $23K, I could put in $23K, but the match for a sole proprietor is only 20%. You don't get to do 25%. So for example, if I made $100K and I'm a sole prop, I could put in $23,000 as an employee. Let's say you're 44, plus 20% of $100K, which would be $20K. So I could only do $43,000, whereas on a $100K W-2 in an S corp, I could have put in $48,000. So the difference here is the 20% match versus 25% match. Sole proprietors only get 20%, S corporations get 25%. The other difference is the tax return and contribution deadline is April 15th plus extensions, which gets you out until October 15th. So that's the contribution deadline for sole proprietorships. Even though you're into 2025, you can still make 2024 contributions up until those deadlines. Now, the next thing I want to go over is the plan setup deadline. This is really critical if you're setting up a solo 401k and making your first year contributions. There's a rule that goes over what is the deadline for making your first year contribution and when does the solo 401k plan have to be set up to make the contribution? Now, of course, this is not logical. It is different for S corporations and sole proprietors, so I have to explain each of those separately here. Let's go over S corporations first here. This is really important. If you have an S corporation, your deadline to set up the solo 401k if you want to make full contributions, employee and employer, is really December 31st of 2024. If you want to make 2024 contributions, you need to have it set up by December 31st, 2024. Our internal deadline is more like December 10th or 15th. If you want it set up by 2024, I mean, we're setting these up every day in our office, but we need time to get actually set up, the docs done, signed, and then filed with the IRS. Now, again, this is if I want to make employee and employer. The reason for this and why you need to have it set up by year end is I need to be able to elect to make the contribution for the employee side in the tax year, and it needs to be on my W-2 in January of 2025. So I need to really have it set up by the end of the year. Now, for sole proprietorships, you're going to have more time. And also, if you're like, Matt, I made $100K on my W-2, I want to put $20,000 in, and it's an S corp, I could just make an employer contribution. It doesn't matter. You don't need it set up by year end. The employer contribution deadline is really only March 15th plus extensions up to September 15th. So in other words, if you just want to make the employer contribution in your first year and you're an S corporation, you don't need to wait until year end. And you can still at least do your employer contribution into the solo 401k for 2024 prior year taxes. Now, the solo case setup deadline for sole proprietorships is different. Of course, this has to be complicated. This is the tax code. This is why the tax lawyers make all the money. The deadline for a 2024 solo 401k is April 15th, 2025. You do not get plus extensions here. It is period April 15th, 2025. Even if you do extend and you're a sole proprietor, if you don't have it set up by April 15th, 2025, you cannot make 2024 contributions. So I recommend getting it set up now or anytime between now and April 15th, 2025 if you still want to make 2024 employee and employer solo 401k contributions for any of you sole proprietors. Now, the last thing I want to go over here is doing the employer Roth contribution. This is a little tricky. You need to know how to do this because this is a new rule from Secure 2.0. IRS finally gave guidance on this in 2024-2. This is a guidance they gave to say, how do you actually make a Roth contribution as an employer? Now, when you're doing employee contributions, whether that's traditional or Roth, it's going on the W-2. You note the amount of the contribution and whether it's traditional or Roth, it's coded different, and that's right on the W-2. There's a lot of guidance and information on how to do that properly. Most payroll companies know what the heck they're doing there. It's the same whether it's a big company 401k or a solo 401k, it's getting coded all the same. But with this new rule and saying, well, you can make employer Roth contributions, everyone's confused on how you're going to do that. Here's why. Now, when you do an employer contribution of traditional dollars, it's really easy. Let's say the company's putting a $25,000 solo 401k contribution of traditional dollars into your solo 401k account. They just take a $25,000 expense on the company tax return as an employee benefit. Easy. It goes into your W-2. It's not taxable to you because it's pre-tax. It's traditional dollars. It's going to grow and come out and you're going to pay tax on the way out. But with Roth dollars, what's happening is they're putting in post-tax dollars that's going to grow and come out tax-free. The company needs to expense it because they're putting this in for you. And just think of a big company or you're solo K. You've got to expense this on the company's return, which you're going to do. Well, the IRS said, well, how is the individual employee going to pick this up as income? Well, what's going to happen is you're going to need to issue a 1099-R for the Roth contribution from the company to the employee so that they pick up this income. And so there's more details on that on the IRS notice, but just know when you're doing your solo 401k contribution, you want to make sure you're working with a company that understands this. Your payroll provider, your accountant needs to be aware of this, making sure this is getting reported properly on your W-2 and then on the 1099-R from the payroll company or your accountant that's actually helping you calculate and make these Roth contributions. Now, you can also help it directed and making sure you understand these rules and what needs to happen, but this is the new process and this is the new norm. A lot of solo 401k owners like Roth dollars, so we're seeing a lot more Roth contributions happening, whether it's employee and employer in a solo 401k. Now, we have a ton of guidance on this at our website at Directed IRA. I have an entire chapter in my book, the Self-Directed IRA Handbook, that's like 50 pages long on solo 401ks specifically. We have webinars, podcasts on this topic. We love the solo 401k. We have thousands of them here at our company, Directed IRA. We're helping clients every day set these up because they are the #1 retirement account for self-employed people with no employees. Now, to get started on setting up a solo 401k, click the link on the screen here. It'll connect you with team members in our office where you can book a call, go over the strategy, get the plan set up. Maybe you need a lawyer consultation in the process. We connect with our law firm that goes over the process. You get a lawyer consult. Maybe you know what you're doing. You have an accountant or CPA helping you. You can do the docs only. Either way, we got a process process to get the solo 401k set up for you so you can start taking advantage of any of these tax deductions you might need by year end, and also growing and building your tax advantage future using the most popular retirement account for self-employed people, the solo 401k. And finally, please subscribe to the channel if you haven't already. I've got tons of tips on saving taxes, protecting your assets, growing and building wealth. I'm Matt Sorensen. We'll see you next time.